Welcome back to EDS, and in this video I'm going to show you step by step how to find hidden trading opportunities that other people aren't looking for or don't know how to find, and these opportunities are going to give you very high probabilities of success and very high returns on your capital. So the first thing you want to do is pull up a watch list of futures that have options contracts available to trade on them. If your broker, platform or brokerage doesn't natively provide this watch list, then just copy these tickers, symbols and make your own. And then the important thing that you want to have on your column section is IV rank, and you want to order your watch list from high to low IV rank. This is because opportunity is where volatility is, and we are going to be writing contracts, which means we're short the contract. And when volatility is high, option prices are high, and we want to sell high and buy low. So we want to get into a position when volatility or IV is high relative to that specific underlying. So we only want to look at things to trade that have an IV rank of at least 30. Anything over 30 is high, anything over 50 is very high. If you have a smaller account, stick to things like currencies, soybeans, bonds, because not much buying power is required for those. If you have a larger account, then feel free to trade anything you like. Whatever it is that you choose to trade, make sure that it fits well in your portfolio. Don't be too heavy in any one sector or underlying, and for the most part you'll be fine. So let's go with the Canadian dollar futures with an IV rank of 78 right now, which is super high, and it has an absolute IV of 8.7%. So we're going to open up the trade tab, and now we are presented with a list of option expiration dates that we can choose. The one that we want to pick needs to be between 30 and 60 days out in time. So we've got one here, 49 days, April 4th, and that lines up with the 60 M5 contract. So we're going to open that up, and now we can see the options chain. We have calls on the left, puts on the right. We have our dotted blue standard deviation levels. We have this orange horizontal line that shows us where the price of the underlying is with respect to the strikes. And in the top right corner, you can see we have our IV percentage and the expected move in parentheses. And the expected move is also visually represented with this vertical orange bar. So when we are writing contracts, we want price to stay away from those contracts. We do not want price to breach those contracts. We essentially want those contracts to be out of the money and stay out of the money. So if we know what the expected move is, we simply just want to sell contracts outside of the expected move, and that's going to give us a high probability of success. So the further out you go, the higher your probability of success will be. However, the less your return will be, because you will be collecting less premium on entry. So a medium or middle ground for me that I like to be at is the one standard deviation level. So the one standard deviation level will typically line up with a 15 to 20 delta. So as you can see, we've got positive deltas on the call side, negative deltas on the put side, and we want to make sure that we are delta neutral on this trade, which means that we are neutral in direction. We don't care where the market's going to go, or essentially we want price to kind of stay range bound or within a certain range, but we don't really need to worry too much about setting levels, because the delta is going to do it for us and our standard deviation level is going to do it for us. This is based on statistical analysis, not technical analysis or anything like that. So on the call side, we have a 14 delta at the 0.725 strike, which we are going to sell. And then on the put side, we have a 14 delta at the 0.69 strike, which we are also going to sell. And what you'll notice is that both of these contracts are around 15 to 20 deltas, and they are pretty close to the, or pretty much smack bang on close to the one standard deviation level, and they're also outside of the expected move. So this is a great setup for us right now. And if you look in the bottom left corner, we have a pop of 66%, and pop is probability of profit. So you've got a 66% chance of this trade working out in our favor, and that's if we hold all the way to the expiration. And we basically want price to be within this range at the point of expiration, and we'll make money. But we don't have to hold to the expiration. We can get out at say 50% of max profit, and we have this P50 number here, which isn't displayed for futures, but it's typically 10 to 15% higher than your pop. So we're looking at about an 80 plus % chance of success if we were to get out 50% of max profit, and we would collect $230 upfront on this trade, and our broker is going to require just over 2.2k in buying power to open this position. So we're getting about a 10% return, which is pretty nice. However, this is pretty conservative, so let's see what happens if we decide to be a bit more aggressive and go one strike in on either side. Now we are collecting just under $400, but our buying power requirement hasn't increased by 400. Our buying power has only increased by a couple hundred. It's now at basically 2.5k, so our return on capital has increased. And just to show you that this works for all underlyings, let's just go to, say, the live cattle futures, and we're going to do the exact same thing April 4th, and we are going to sell one call and one put. Let's say we start off at the 15 delta on the call side, 15 delta on the put side. As you can see here, we got a 68% pop, which means we're going to have an 80+% P50. Our max profit is $640, and our buying power requirement is under 1.1k. So this trade here for live cattle is actually going to give us a way higher return than for futures. So you want to kind of go through the list and see where you can best allocate your funds. We have a return here of over 60%, as opposed to before it was 10% on the Canadian dollar, and this is pretty conservative. If we were to go to the 20 delta on either side, you know, now we're collecting $930 up front, and our buying power requirement is just under 1.2k, so we're closing in on almost a 100% return on our money here. So this is basically what you need to do, and you need to do this over and over again. You want to have as many occurrences as you can in order to let the probabilities and odds work out in your favor. You do need to keep in mind how much buying power you are allocating to your positions. Position sizing is very important, and in order to figure that out, we've created a free position sizing template that's available for everyone to use. The link is in the description. Just click the button and it will take you over to this spreadsheet. The way it works is you enter in the size of your portfolio at the top. So say if you have a $100,000 account, below you can then enter in whatever the current VIX level is, and everything will be automatically calculated for you. Let's say if the VIX, in a month's time was to be at 32.1, as you can see the numbers change. So it is giving you recommended buying power levels to allocate, or your maximum buying power levels to allocate to certain positions, etc., based on the size of your portfolio and current market conditions. And as long as you follow this, you'll be absolutely fine over the long run. If you would like to learn in more detail about what we do, how we do it, click on EDS Premium. The link will be in the description, and get yourself signed up. Once you're inside, you will have access to our portfolio that will allow you to see the positions that we place, how we manage risk, how we make adjustments, all in real time. And there's also a full course, so no prior knowledge is required. We will teach you everything that you need to know. And because it's a private community, that means that if you get stuck at any point, you can speak directly with myself or with other like-minded individuals. And there's a 100% money back guarantee. So once you have been through the full course, followed some of our trades for at least 6 months, if at that point for whatever reason you are not profitable, then we will work with you for free until you are, or you can simply request a full refund. And right now to join, it is $9.99 a month. The price will be increasing. That's not a sales tactic. The price used to be £1 a month for the first wave of members. The first wave of members is now full, so now we're on the second wave. Once this second wave is full at $9.99, then we will be increasing the price for the third wave. So you are rewarded for getting in early. And the aim of EDS Premium is to teach you the skill. We do not want to keep you dependent on us. We want to give you the skill, and once you've learned it, you can take it with you for the rest of your life. No one can ever take it away from you. And we want to get you to that point of where you are completely self-sufficient within 6 to 12 months. So with that being said, I will see you guys on the inside.